Okay, so in the last video we looked at assets and liabilities and how to calculate up our totals on both of those. Today we're going to talk about inventory and depreciation and appreciation and debt to equity ratio and also net worth. And we're going to be using our assets and liabilities for a lot of these things. So inventory, this is where we're going to start. Inventory is an itemized list of things that are owned by a business, and typically this includes the beginning value of each item and also the depreciated value of each item. So the beginning value is what it was worth when you got it, and then the depreciated value is what it's worth over time. So depreciation means that an item will decrease in value over a period of time, and that could be due to advances in technology. This could be due to wear and tear, anything like that. Anyone still trying to use an iPhone 4 now that the iPhone X has come out, your iPhone 4 is depreciated a great bit at this point. Appreciation means that an item increases in value over time, and the main example that I can give of this would be either land or a building or structure. So we only have a given amount of land. We can't make more of it. What we have is what we got. So once you purchase a chunk of it, then the value of that is going to go up over time because the demand for land is going to go up over time. So non-depreciable inventory. Non-depreciable inventory is any item that will be used up or sold within a year. Things like feed, things like supplies, whether they be medical supplies or farm supplies if you're running a farm, something like that. These are items that are not affected by depreciation. So if we're looking at a vet clinic, things like medications for the animals, things like cleaning supplies. Trust me, a broom is not going to depreciate over time because as often as you use it in a vet clinic, you're probably going to buy a new one every year. Then there's depreciable inventory, which is the opposite of non-depreciable. So depreciable inventory are items that have a useful life of more than 1 year, and they can lose value because of age, wear and tear, becoming out of date because of technology advancements, anything like that. Either way, they're going to lose value over time. Okay, so things like surgical equipment. The best example I can probably give is different types of cages, right? Things like that if we're looking at a vet clinic example. Any furniture, that sort of thing. So land. I want to talk about land for just a minute because land is a little bit funky. We'll call it the exception to the rule. It is not depreciable property, and the main reason for this is because, like I've already kind of said, we've only got a certain amount of land. So once you've acquired a chunk of it, that chunk is only going to go up in value. It's not going to decrease, typically. Now there's an exception to everything, but for the most part, you can count on land and housing and buildings to appreciate in value rather than depreciate, even though it has a useful life of more than 1 year. All right, so net worth. Net worth or owner's equity, the two terms are interchangeable. This comes from our assets and our liabilities. So if we take our total assets or total amount of money that we have in our pocket and we subtract out anything that we owe and anything that takes money out of our pocket, we get net worth or owner's equity. That's basically just a fancy way of saying what you actually have in your pocket. So debt to equity ratio is actually going to use net worth. So debt to equity ratio is a measure of a company or an individual's net worth compared to their liabilities. So this really, it provides an indicator of the debt and the equity that a company is using. And the main reason that we use this is if a company is trying to finance something, okay, or take a loan out on something. Let's say a vet clinic desperately needs a new cadaver freezer, and they need to take a loan out for that. The bank would look at their debt to equity ratio to see how much money do they owe to people and how much do they actually have to pay it with, if that makes sense. So the formula that's used to calculate debt to equity ratio is total liabilities divided by net worth. Okay, and it is a ratio, so we're not going to give a solid number here. We're going to give a ratio, either in the form of a fraction or this ratio format right here with the colon between the two values. So let's just say that we have $100,000 in liabilities. Maybe that's a $100,000 mortgage. That's the only liability we have. But you've got $400,000 net worth, all right? And remember, net worth is the balance of your debts and your assets. It doesn't necessarily mean that all $400,000 of your dollars are sitting in the bank, all right? That means that you've got vehicles that are worth money, and you could sell those if you needed to pay off this debt. That's all calculated in there. So you don't necessarily have $400,000 sitting in the bank, but you have $4,000 worth of stuff that you can liquidate in order to pay off your debts. Okay, so if we take our total liabilities over our net worth, it's going to be 1 to 4. Okay, so that's our debt to equity ratio, is a 1 to 4 ratio. That's all we're going to cover as far as finance goes. Again, please let me know if you have any questions. I know this can get a little bit obscure, and to be honest with you, even being an adult, it's still obscure. Looking at buying property and stuff like that, it gets a little bit confusing. So absolutely let me know if you have any questions. Otherwise, thanks for watching.